Vitrio Financial is proud to support Improving Alpha, Innovation in Investing, ESG and Technology with Michael Oliver Weinberg. Vitrio helps allocators harness investment complexity to make better allocation decisions. Learn more at vidrio.com. That's vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG and Technology podcast series. On that note, let's get right into it with our esteemed guest, Jeff Mindlin of ASU Enterprises. Jeff, first of all, welcome. Thanks for taking the time to join us.
Thank you.
Maybe we could start with your background and then segue into what Arizona's ASU Enterprises is.
Sure. So I studied econ and finance actually here at Arizona State University and really gravitated towards econometrics and investing. I was really intrigued by this idea that you could build models to predict stock market behavior and pricing and returns. But it was really a nascent topic at the time, especially here. And one day a research professor came in to talk to one of my classes, and he was doing a lot with academics and building quant models to score stocks, and kind of a light bulb went off that this is what I wanted to do. And I'd never really heard the term financial engineering before, but found my way into working with him. At the time, he was only hiring PhDs, but he was able to hire me cheap and kind of figure out exactly what I could do and train me to do it exactly the way he wanted to. So this was the early days of the internet, and we were working at the time then with MSN Money. They were looking for content and trying to drive people to their page. So built a stock scoring system for them. Did a lot of Intel Inside for Thomson, where they were trying to use properties like IBIS and the analyst data to build scoring models to sell to clients. So we built quant models. And then I had a little bit of luck. All of the senior financial engineers on the team either left or married each other and moved away. So I went from being the most junior, only non-PhD to being the senior member of the team and got to start to chart a course for myself and was really more interested on the money management side. And he had some small hedge funds, so I started working on that side. And then he ultimately spun those out and was acquired by a broker-dealer that was looking for some internal investment capabilities to sell to their high net worth clients. And through a series of future acquisitions and divestments, found myself as CIO at the second largest independent broker-dealer, where we had about 10,000 advisors that we were building strategies for, and about 5 billion of assets. And about 5.5 years ago, I left that to return to my alma mater to start building out an internal investment team. At the time, we had about 650 million in assets and had a line of sight to a billion or more. And our board really wanted to start to build out those internal capabilities as the sophistication and assets in the endowment group.
You mentioned that at the time you had $650 million in assets. Presumably that's materially higher now?
Yes, we're about 1.3 billion in the endowment today.
Nice. And what is, in terms of the endowment, what is the objective?
So I oversee 3 pools with about 1.5 billion total. There's the traditional endowment, which is about 1.1 billion. We have 200 million in a separate sustainability geared endowment, and then the balance in operating funds. Within the endowment, really the objective is to meet our annual payout that supports the university. What
could you give us a sense as to what that what that requires? You're paying out to help fund the school's operations.
Exactly. So the payout works out to about 5.5% when you think about fees and other expenses. So we're trying to support that payout. We're trying to grow sufficiently to maintain intergenerational wealth. So that looks like 5.5% real rate of return over time. So call it 7 to 8% nominal under normal conditions. But obviously it's a very different game right now given where we're seeing inflation.
Right. You mentioned the sustainability in component of the endowment. Obviously, it's materially smaller, but that sounds super interesting. And ESG is certainly one of the subjects at the top of this podcast and my mind. And frankly, much of the world. I've been teaching at Columbia Business School for more than the past decade, and ESG has been part of our class. And the interest in ESG is almost 100% now, whereas sort of 10 years ago, plus or minus, when we started teaching it, there was minimal to no interest. Maybe you could talk a little bit about that sustainability component of the endowment.
Sure. I mean, we've been really on a journey to think about how do we align the investment strategy of the endowment with the mission of the university for longer than I've been here. But one of the issues that we had seen a couple of years ago, as we were thinking of different sustainable or ESG strategies, we got into a lot of discussion about whether we should be doing it and not how do we do it. So a couple of years ago, we had the idea of creating a separate pool with an explicit mission alignment mandate. And there within that portfolio, again, we could kind of take that question off the board and really focus on implementation rather than whether we should be doing it. And so that's really served as almost a petri dish for us to think about what are tools and techniques that we are interested in the realm of sustainable investing, try them out within those assets, get comfortable with them, use it to educate our committee on the merits, and then think about advancing or maturing those approaches to the main endowment pool. The other thing that having that explicit pool has done for us is it's a little bit more manageable. So we've got less line items and less legacy investments. So as we think about the reporting and different things like that we want to do, it's a little bit more easy to get our arms around some of these tools and strategies within that bucket of assets rather than the full endowment that's got more than 100 line items when all is said and done.
And so what could you drill down a bit, maybe give us a little more granularity in terms of what are some of the initiatives you're working with in there? Is it impact investing? Is it, more color would be helpful.
Yeah. So, this is again, I think going back to our mission, a big focus of the university. We were recently ranked #1 cool school by Sierra Magazine, indicating that we're the most sustainable university based on criteria ranging from academics to research to operations to the investment side. So, this has been one of the areas that we focused on. And really we've thought about it from a fiduciary first lens. We're not interested in reducing returns. We also, don't want to bring politics into the purview. And despite the current national dialogue, our objectives here have been to not politicize the endowment by thinking about, a topic du jour on divestment or things like that. But we really thought about it, I think, in a couple of different ways. On ESG in particular, thinking about those as non-financial metrics that are helpful in understanding risks. So ESG as being more of a risk lens. And in that case, we're not typically picking stocks directly ourselves, we're hiring managers. So finding managers that have thought about how do they integrate that into their security selection process? And then we've made a net zero commitment. So the university achieved carbon neutrality on scope 1 and scope 2 a couple of years ago and has a 2035 target for scope 3. So we think about the university and their scope 3 ambitions. We're theoretically part of their financed emissions or the investments are. So, in order for them to achieve that objective, we need to do it with the portfolio. So thinking about that, it's a little bit more aggressive than, the 2050 that a lot of others have, but again, aligns with the university. So as a starting point, we were really hesitant to think about divestment. We didn't want to reduce our opportunity set. We didn't want to, again, politicize the endowment by trying to respond to every issue and thinking about stocks to not hold. And ultimately, we don't find that as a really effective method in reducing the carbon dioxide in the environment. It doesn't really change the carbon in the atmosphere. It's just passing it along to a buyer that maybe doesn't care about it as much as we do. So we've been really focused more on the engagement side, at least at this stage, where we haven't explicitly divested from groups. Again, we're thinking about ESG as a risk, but on the engagement side, have really thought more about proxy voting around shareholder resolutions, and then direct engagement with companies. And then I think what's interesting, again, we're a university. I've got a small team, 3 full-time people. So we don't necessarily have the resources internally to do a lot of that work. So we've been really thinking about how do we tap into our student body to help us and extend our reach into those areas. One of the things that our university president has said before is higher ed makes up less than 5% of the carbon footprint, but we make up 100% of the learning imprint. And so, I think there's, again, this double bottom line benefit. Not only are we doing the right things by, again, some of our focus on engagement, but by tapping into students, we're empowering and educating that next generation that's probably going to solve these problems, and giving them a different perspective on how they can affect change in the portfolio.
Yeah, look, I couldn't agree more with you in terms of engagement versus exclusion. I recently wrote an article, or this past summer, I think, that Institutional Investor published on that. I call it optimal ESG, but yeah, I mean, 100% in terms of what you say. The risk is that, not that it gets far worse, that the companies get pushed into hands of people who are not accountable. There aren't public shareholders, and they run the companies purely for profitability at the expense of the environment, for example, in terms of exclusion of fossil fuels or divestiture. So yeah, couldn't agree more with that. And it's great that ASU has that sustainability initiative, and it's really quite sensible. Maybe it's a good segue into you're discussing a bit more about how you use the students, because you mentioned that 100% the ability to influence or educate 100% of the students, and I think you're doing some innovative work there as well. I think the audience would like to hear about.
Yeah, so a couple of different aspects. So early on, we had created a student managed fund program, and again, I think you see a lot of those across academia. What's unique, I think, about ours is that the faculty that leads it has, again, more of a quantitative background. So it tends to be less about stock picking, where you get a bunch of students in the room, and they're kind of arguing about, do they like, Tesla or Facebook or Google more? But again, having to build a model and really think about factors and things like that. So it brings in coding, and it brings in, a lot of statistics and math and other things along those lines. Portfolio construction, they've got a benchmark that they've got to think about. So that's been a really neat program. We have we've allocated enough money for 3 different student groups to invest there. They get about $1 million each, 2 undergrad and 1 MBA team. Then a couple of years ago, around the time that we were creating our sustainability, we were, again, dealing with, I think, the education element of responsible investing, or ESG, or sustainable, or whatever term you want to use, and thought that would be another valuable exercise where we created another student managed fund for students, where, again, there's really no explicit target other than, build a sustainable portfolio, and they've got to decide what that means. Are they going to take a divestment approach? Are they going to take an impact approach? Are they going to take an ESG approach? Are they going to, buy stocks that are bad so that they can engage with them? And really leave it up to each crop of students to understand the full spectrum of responsible investing, and then pick a strategy around it. And then we have a real estate one where students are trading publicly traded real estate stocks, REITs, and doing more of a fundamental analysis on it. And then this year we launched a venture capital strategy where students are learning about that field, and then helping make a typically 1 to 2 edtech venture capital investments at the end of the year. So that's been the core part of the program, and then what's really grown in the last couple of years is students on the engagement side. So we helped some students create a group called Sci-Fi, the Student Impact Finance Initiative, and that's become our engagement club, essentially. So they helped us work on our proxy voting policy, and write that out, and put pen to paper on crafting a policy. Now going forward, they're helping us with the voting of our proxies. So they'll review the manager recommendations, they'll review our research provider's recommendation, and then evaluate each proxy in the context of that proxy voting guidelines, and make a recommendation to us on how we should vote. So they're able to, again, to do a lot of the heavy lifting in that realm, but we retain control and oversight. They're also the group that's done some of our corporate engagements. So they've had an ongoing engagement with Chevron, where, again, they've been really measured in thinking about it. It's not a whole bunch of crazy students getting on there and telling Chevron that they're bad. They've been talking to them in a really diligent way about things like lobbying, and how some of Chevron's stated objectives and goals might differ from the money that they're giving to lobbying efforts or some of the industry trade groups that they spend money with and what those groups are doing, and trying to reconcile those differences. They've talked with BlackRock about some of the diversity, equity, and inclusion efforts that they're doing. So it's been really interesting on that side. And then this year, we're hoping to co-file a shareholder resolution where we can maybe work with a similar student group at another university and co-file a shareholder resolution with them on a company that we've seeded our stake in. So it's been really neat. You know, we've had students and people from the team move on to series and other engagement working groups and things like that as they've matriculated, and again really learned, I think, a lot about, you know, the impact that we can have, and again why maybe having some ownership, you know, retains that voice that can actually affect change.
So your innovation in terms of ESG is clearly fantastic. I mean, I'm on the board of the Michael Price Student Investment Fund at NYU, and we do sort of a complement to what you do, because we're more of the sort of old school discretionary equity investing, which is sort of, it seems like you're doing everything but that. But you know, you've certainly inspired me with some great ideas that we could expand into. Shifting gears to innovation in technology and improving alpha from technology. You know, maybe you could touch on that and let us know how you're using technology to improve returns effectively.
Yeah, I mean, I think going back to the university, we've received the #1 in innovation designation by U.S. News and World Report for 8 years running now. So again, we think about tech, think about innovation. Again, these are things at the core of who we are. So I've been spending a lot more of my time as of late really thinking about how do we better capitalize on our venture ecosystem as the most innovative university. We're also top 10 in the country for patents of schools that don't have a medical school. We've got the largest engineering school in the country. We have the first school of sustainability that now houses the grandfather of carbon capture technology. We had one of the earliest and one of the premier online education platforms. So, you know, we've become really vested in a lot of these areas, whether it be education technology, clean tech, space tech, dual use tech with military things. We have a partnership with Mayo, so on the med tech side. So really thinking about how do we tap into a lot of those innovations and companies, venture capital firms that want to play in those fields, and have that drive part of our private equity allocation in a way, again, that I think is forward thinking about where the puck is going from a futurist perspective, but then also, you know, helps advance the university as well. And we've got unique insights into a lot of these realms. One of the things that we saw in fiscal year 22, we had a positive return for the year. We were up about 2.5%, which, you know, in that year we were really happy about. But part of that lift came from, you know, an ed tech investment that came from a special partnership with the university that had a really big markup. So we're starting to see the monetization of some of these things where, you know, the university has benefited, or the community has benefited, or again, kind of the broader entrepreneurial spirit is there. But we're able to identify the ones that also are good investment opportunities for us to take advantage of. So that's been a big area, especially in those key verticals that I mentioned.
That's fantastic. Again, another great way you're integrating the university and the ecosystem you have with the innovation and ESG and investing and generating returns for your to fund the school. So sounds like a great circular system. You talked about looking at where the puck is going. So looking at where the puck is going, where do you see the best investment opportunity now or a few interesting opportunities, if you prefer?
Yeah, I mean, it's obviously a much different environment today than it was a year ago. You know, my personal view is, you know, we're obviously really oversold on the stock market. Probably getting closer to the bottom than not, maybe not the bottom, but a bottom. So, you know, in that world, you know, there's probably returns to be had in lots of places. You know, where we've been focused, again, kind of building off of that previous idea is venture right now. We historically had been underweight private equity relative to our strategic asset allocation. So really over the last 5 years, we've tried to grow that bucket from, you know, what was maybe 7% when I came in versus our target of 21% to get closer to our target. And at the same time, almost had the opposite of the denominator effect, right? Our denominator's grown, so that delta kept getting bigger and bigger as the goalpost got farther away. So we've done that largely by thinking about a strategy that combined secondaries, primary funds, and then direct co-investments, where we were trying to avoid as much of the J curve as possible. We got a big chunk of the portfolio ramped up into PE. As a result of that, we probably ended up being a little bit more focused on growth equity and buyout than the VC side. So as we stand today, a little bit underweight venture, especially relative to a lot of our peers. So that's been in the back of our mind, and obviously with what's happened in the market, we think that the next few vintages are probably going to look really good. So getting more money to work in an explicit way in venture at this point makes a lot of sense for us. Focus more on the earlier stage where the prior maybe unrealistic valuations and concerns about down rounds maybe aren't as much of an issue, and capital is slowing, especially in some places. Competitive landscape for talent is lightening up a little bit, but still aren't seeing a slowdown in innovation. So again, we're thinking that now is a good time to be putting more money to work in venture, given that we historically have been underweight there. I think there's a lot of opportunities just generally with just the structuring of deals, where deals right now where you're seeing, preferreds or converts or some kind of debt structure, having, similar returns as you normally get from the equity side. That's really interesting right now as well. But again, spending a lot of time on venture right now in the portfolio, given the current opportunity set.
Yeah, I couldn't agree more. I mean, you're now, I mean, with public market valuations down 50 to 70% and private market valuations down materially, if not similarly, I agree. It's a great time to be to have dry powder in venture and secondaries. Secondary private equity is also quite interesting. I think we discussed an article I wrote that I published on the denominator effect, and you happen to be in the lucky minority, that is not massively overweight as much of, if not most of the institutional world is, and can take advantage of that and be a buyer where they need to be sellers.
Exactly, and we're in a fortunate spot as well, where given that we're not a kind of a closed foundation, right? We're still open. We're taking new money, and we've been on just coming out of a big campaign, so we're seeing new contributions coming in as being really strong, and so we have more money coming in than typically our payout is, and so as a result, we've got a little bit more flexibility with liquidity as well, where we can overshoot our targets on the illiquid side and have some comfort that we're not going to get into any liquidity challenges that otherwise might arise, and so can take advantage of some of the markdowns on the private side currently.
Right, absolutely. So at this point, let's shift to a slightly different format, what we refer to as the lightning round. So I'll ask a sequence of questions, and we'll look forward to the answers. What's the biggest challenge to achieving your goals?
I think inflation right now. I mean, as I mentioned, our payout is based on growing in a real way, and and inflation in a 7-8% world is very different than 2%, and obviously the tack on impact on other asset classes. So that's something we're spending a lot of time worried about and thinking about right now on how transitory it is or isn't.
Next question: what's a red flag with a manager such that you would not invest?
And clearly anything on the ethics regulatory side, but as a rule of thumb, we've got a no jerk policy. There's lots of smart people out there. This is a relationship business, and you got to enjoy the people you're working with. So we want those relationships with managers that'll last.
Here's a bit of an awkward one, but what's a material mistake you made investing, and what's the lesson learned?
I mean, it's a humbling business, as I think everybody knows, and those of us that are more seasoned and have lived through cycles, part of the value is pattern recognition. History doesn't always repeat itself; it rhymes. So in the GFC, real quick, we had some pairs trading looking for dispersion, and we're very wrong on kind of the underperformance of financials relative to other places. It was more of an early warning sign than an opportunity, and really got burned on being early on the financials.
What's your favorite book or one you've read recently?
So right now, and this might be interesting to you on the Columbia side, but reading this new book, "Investing in the Era of Climate Change" by Bruce Usher, who's a faculty there at Columbia. But again, thinking about the opportunities that come from climate change, transportation, ag, manufacturing, transport, the net aspect of it. He talks a little bit about with carbon capture, which I mentioned before, is something that we're really interested in as well.
What advice do you have for other allocators and investors?
I think, especially in my world, this is a super collaborative space, right? So versus the private sector. So I think the collaboration of picking up the phone and talking to peers, it works, especially in some of these uncharted waters, like the ESG, sustainability, net zero side. None of us have all the answers right now. And I think sometimes there's a fear of having it all figured out before moving forward. And again, talking to each other, I think sometimes it helps alleviate that and help with a strategy that's worked for others.
And my favorite question for managers: what didn't we discuss that we should have, or what didn't I ask you, or what are you discussing with other investors that's super interesting?
I think China is going to be the issue that doesn't go away for a long time. Historically, a lot of us had started thinking about it as an investment opportunity where it's underrepresented in market cap relative to economic impact. Obviously, the growth everybody's aware of, the bipolarization between US and China leads to diversification issues, even in light of the governance and social issues. But certainly after the Russian invasion of Ukraine and the restrictions on security trading in Russia, I think all of us are just a lot more acutely aware of the growing risks of a Chinese invasion of Taiwan and the idiosyncratic risks that come from there. And like I said, I think every committee meeting, for the last 6 or 9 months, that's been a topic. Every manager meeting, every investor conference, like China's a big deal right now.
Absolutely. And maybe in a later podcast, we'll have time to delve more deeply into that. But look, I'd like to thank Jeff for his sharing his most valuable asset with us, his time. And, I hope that was informative in terms of how, for our listeners, how Jeff and ASU is improving alpha and innovating and investing ESG in technology.
Thank you for listening to Improving Alpha, Innovation in Investing, ESG and Technology, sponsored by Vidrio Financial. With Vidrio Financial, asset managers, endowments and foundations, pensions, family offices, insurance plans and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's vidrio.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.